Hey, Lance Morgan here, and in this short video, I'm going to show you everything you need to know to reduce the college loans and loan payments. This is actually one of 4 college funding secrets to cut the cost of college. Number 1 is all about maximizing all that free money from the schools through scholarships and financial aid. Secret number 2 is what I want to talk about in this video, which is all about literally cutting the college loans and loan payments. And I know that a lot of you want to avoid loans like the plague, but using college loans strategically could actually be a huge savings. And then of course there's secret number 3, which is how to pay for college and get an entire refund on the cost of college through what we call the retirement scholarship strategy. And then there's secret number 4, retirement restoration, which is 3 strategies to triple your income in retirement to make up for the cost of helping your kids pay for college. But in this short video, I want to focus on secret number 2, which is a bigger savings for most families than actually getting scholarships and financial aid. So let's go ahead and dive right into it. If you don't know who I am, my name is Lance Morgan and I have 5 kids. So I understand the stress of helping them pay for college. My oldest 2 daughters are actually in college. One just got married, my other one is starting this year, and my little guy is in elementary school. So I am going to be doing this for a long time. I've already been doing it for a long time, and I want to teach you all of the tricks that could help you to reduce the cost of college. Now, again, we're going to focus on secret number 2, which is how to reduce the college loans and loan payments, because cutting the cost of these loans could be the equivalent of saving money on college. So if you could cut your college costs and college loans in half, that's the same as cutting the cost of college in half. So this is a huge savings and one you shouldn't ignore. Now, I know that there are a million reasons why you want to avoid college loans, but I want to have you consider maybe why you might want to use federal college loans to pay for college. Now, before you start thinking about what is the interest rate on the federal loans versus the private loans, I want to show you a couple of secrets that most people don't know about, which is the loan interest rate is not the most important consideration when you're trying to choose loans. Yes, you might be able to get some private loans at a lower interest rate, but these federal loans have some other benefits that you might not know about. And using these loans strategically could actually be a huge savings, even more savings than scholarships and financial aid. And this is one of the other reasons why we don't recommend using 529 accounts or traditional savings or retirement or even whole life insurance or your cash flow or any of these traditional ways of paying for college, even if you can afford to pay cash for college and even if you do have enough money saved to pay for college. I strongly encourage you to watch this video until the end because you may want to use college loans to pay for college instead, and I'll explain why. Now, a little bit of backstory before we dive into that. You can see back in about 2009 is when the federal government standardized all the college loans. It used to be that private loans were all based on a school-by-school basis, and then the government decided they wanted to standardize all the loans so everyone would pay one interest rate. Well, there are still private loans out there, but as you can see, the federal loans have taken off like crazy. In fact, going all the way back to 2012, over 36% of the total federal government's assets were in college loans. Now, if that doesn't surprise you, fast forward to 2019, and since 2019, more than half of the federal government's assets are coming from student loans. Now, I would question this just a little bit because technically the government owns a portion of everybody's retirement, because if you have a qualified plan like a 401k or an IRA, it hasn't been taxed yet. So when you take that money out is when you're going to pay taxes on it, and the government owns part of that. But other than that, on the books, as it stands right now, based on all the other assets they have, including taxes receivable, which taxes receivable is only 7.6% of their assets back in 2019. Over half are coming from college loans. Now that's just a little bit of a backstory, but let's talk about the specifics of the college loans. First, we have our Stafford student loans. These are the loans that they give to the kids. There are subsidized loans where if you're low income, the government will pay the interest on the loans while the kids are in school. Now, usually it's not very much, but they'll supplement some of it. Now, unsubsidized means that even if you're high income, you could still get Stafford loans for your kids, but they would be unsubsidized, meaning that the interest starts to accrue right away. Now, in any scenario, subsidized or unsubsidized, the students can only borrow $5,500 for the first year, $6,500 for the second year, and $7,500 every year after that for an undergraduate education. So for 4 years, that's only $27,000. If they need to go 5 or 6 years, they could borrow a little bit more. If they're going to get a master's degree or some sort of a graduate school, they can get graduate school loans for an unlimited amount. So they limit them on the undergrad loans, but for graduate loans, they can borrow more. But they're pretty limited, as you can see, for an undergraduate education. So you, as parents, are going to need to help. And parents can borrow the difference in the government loans, the federal government loans. Now, some people think, oh, I don't qualify for any financial aid. I make too much money. So the FAFSA says I don't get any financial aid. That doesn't mean that you can't borrow the money. Now, you still need to fill out the FAFSA. You have to do the FAFSA in order to qualify for the loans. But no matter how much money you make, you can borrow the money from the federal government to make up the difference. So let's say that the cost of attendance is $30,000 a year, but the kids get, let's say, $5,000 in scholarships, and maybe they get the $5,500 in the Stafford loans. The difference can be borrowed through the federal government loans. Now, doesn't matter how much money you make, and in fact, even if you don't make any money at all. Now, I know you're shaking your head, you're wondering how in the world that works, but yes, when you're filling out the loan application, which I'll show you in just a second, it doesn't even ask how much money you make. Problem is that the government is literally loaning money to people who can't afford to pay back these loans because they're not doing any sort of income verification or anything like that, which means that it doesn't matter if you make too much money, and it doesn't matter if you make no money at all, they will still loan you the money as long as you have a decent credit score and you don't have any like defaults on your own student loans or anything like that. All right, now, here's the big secret. The big secret is what we call income-driven repayment plans. If you haven't heard of income-driven repayment plans, this could be the best news you've heard all day, all right? Now, income-driven repayment plans means that the loan payments are a percentage of the income of the parent, not the parents, that takes out the loans, not the loan balance, okay? It's not about the loan balance, it's about a percentage of the income. That's why they call them income-driven repayment plans, which means that you should take out the loans on the individual parent that makes the lowest income, even if they don't make any money at all, okay? I make decent money myself. My wife does not have a traditional income. We have two girls in college, and we are borrowing all of the money for our girls under my wife's name, who has no income. Why do they give her the loans with no income? I don't know, but they do, okay? And it's completely legal, it's ethical. This is the government's way of helping families to pay for the cost of college. Now, it's not about the interest rates. You should not choose college loans based on the interest rates, okay? Just like it says on the federal government's website at studentaid.gov, if your federal student loan payments, now this can apply to you as parents as well, are high compared to your income, you may want to repay your loans under an income-driven repayment plan. So if you make no income, then whatever the loan payment is, that's going to be high. Now, even if you do make $100,000 a year, but you're going to send 5 kids to college. If you have 5 kids that are all going to go to Ivy League schools and you need to borrow $1 million, well, then your loan payment would probably be high even on $100,000 a year income, right? So no matter what the situation is, you can get what we call these income-driven repayment plans. Let's take a closer look. All right. The first one is income contingent repayment plans, or ICR. It's 20% of your discretionary income for 25 years. That means if you contribute to a retirement account or something, that would lower your discretionary income. So there are even more ways to lower that discretionary income. How about income-based repayment plans? IBR, that's 15% of your discretionary income, but for 25 years, right? Then pay-as-you-earn, okay, repayment plan, or PAY, is 10% of discretionary income for only 20 years. Now, repay or revised pay-as-you-earn is 10% for 25 years. And then if you are on one of these income-driven repayment plans, and if you work for a nonprofit organization, you qualify for what we call PSLF, or Public Service Loan Forgiveness, where it's 10% of your discretionary income for 10 years, or technically 120 payments. And then, yes, after you're done with 25, 20, or 10 years, they literally just wipe the rest away. It is all forgiven. All right, it's all forgiven after the 25 to 10 years or 20 years. And if you become permanently disabled, or if you pass away, heaven forbid, then these loans are forgiven upon death or disability as well. All of which is something to consider when taking out these loans. Now, I am not saying that I agree with any of this. I don't understand why my wife, with her income alone, could borrow as much money as we wanted to send 5 kids to college. Now, all you have to do is do a married filing separately, and they wouldn't even look at my income at all. That means that with my wife, who makes no income, if we did married filing separately, she could qualify for one of these payment plans. For example, right now, it might be PAY, which is one of the more current ones. However, these are changing all the time. By the time you watch this video, they probably have more payment plans that are out there, okay? But it's something that could save you a tremendous amount of money. Now, let's walk through the actual application so you can see for yourself exactly how this works. So first of all, we're going to go over here to the federal government's website, studentaid.gov, and this is where it says if your student loan payments are high and compared to your income, you may want to take advantage of one of these plans. You can read in more detail about all of these plans on their website. But I want to go back up here. I actually want to go over here. This is what it would look like when you first log in, or when you first go to their website, and you're going to go to loans, and then you're going to come over here to Plus Loans, Grad Plus, and Parent Plus. These are the Parent Plus loans for the parent, not the student. These are for the parent, okay? You're going to click on that, and it's going to take you over here to the loan application process. Now, this is going to be for the parent of the student. So we're going to click on Learn More, and we're going to scroll down, and we're going to say that I am a parent of an undergraduate student. And normally, if you were logged in, now again, one parent could fill out the FAFSA, a completely different parent could create an FSA ID and do the loans. So for example, I log in with my FSA ID and I do the FAFSA every year for my kids. However, I log in with my wife, or my wife logs in with her FSA ID to do the loans. Completely different. I do the FAFSA, she's doing the loans. Okay, now, this is not tied to the FAFSA or her income on the FAFSA or anything like that. So normally, if you were logged in, then you wouldn't need to put in most of this information. But I'm going to click on View Demo just to show you how this would look. Now, again, if you were logged in, it would not take 20 minutes to complete this because all of your information is already pre-populated after you've logged in. But this just says you want to make sure that you haven't placed a freeze on your credit. So we're just going to click on OK. And then you're going to choose the award year. This would be the award year that you're looking to borrow the money, right? And then you're going to choose your student. If you've already got your student's information in there, all of this would be pre-populated. So this would be really fast because name, address, date of birth, all that would be pre-populated. Now, here's the cool part. You choose the school that your student is going to, and they will literally send the money directly to the school. Sometimes in like 48 hours, the money gets wired over to the school. Just check with the financial aid office, make sure they got the money. Okay, so you choose the school from this list here. Now you say that you're submitting a new application, click on continue, come over here to step 2. Now this is where you say that I want to borrow the maximum direct plus loan for which I am eligible. So they're going to subtract scholarships, financial aid, the Stafford loans, and whatever the difference is, you don't even have to do the math. Whatever the difference is, they will load you even if your student is living at home. During COVID, my daughter was going to school living at home, and we received a check to help cover living expenses. So you can borrow up to the cost of attendance, even if your student is living off campus. So even if they're living off campus, you can borrow up to the cost of attendance, even for room and board, okay? Then you choose the loan period, all right, that you're going to be borrowing the money. Now, this is extremely important. Request for deferment. Now, most people will tell you that you need to make at least an interest payment on your loans. I'm going to suggest that you defer the payments until 6 months after graduation. Now, yes, it's true that the loans would compound interest while the kids are in school because you are deferring the payments, not the interest. So while the kids are in school, your interest is going to be compounding, but you want to, number one, you want to qualify after graduation for one of these income-driven repayment plans. But number two, there is secret number 3 called the retirement scholarship strategy that we recommend. And there's another video on that where I go into that in more detail, but I'll give you just a little sneak peek on that in just a minute. So if you request deferment, that means that you can defer the loan payments until 6 months after graduation. That allows you to save that money where it could also be compounding interest. Okay, and I'll get back to that in just a minute. Now, you, of course, authorize that. You put a little checkbox there for that authorization, credit check, so on and so forth. You say that you're the parent. You say that you are the biological parent or legally adoptive parent, so you just kind of select all that. Most of this is pretty self-explanatory. You're a citizen. Now, again, all of this borrower's information would be pre-populated after you've already logged in with your FSA ID and password. Borrower's mailing address, again, all pre-populated. And now here is the best part down here, right here. Employer's information. You could check that checkbox that says, I am not employed. Now, even if you are employed, maybe you're self-employed, maybe you're a homemaker, whatever the case may be, whether you're not employed or you're a homemaker, it doesn't really matter. If you look on here, nowhere on here does it ask what your income is. It's not having you verify any sort of income. So the government is loaning money to people they should not be loaning money to because their solution is just to put them onto one of these income-driven repayment plans. It's not helping to solve the problem. It's not encouraging the schools to lower the cost of attendance. In fact, if anything, it's hurting the situation because they are making it so easy to borrow the money that these schools have no reason to lower the cost of attendance. They can keep charging as much as they want to charge because the government is making it so easy to borrow the money. Now we click on continue, as you can see, and this is just a credit check authorization. We say yes, we can have them pull our credit. And then there's a review. This is just reviewing everything that we've done. And then at the very end, you can see that you get accepted and boom, the money gets sent to the school. Literally 5 to 10 minutes is how long this takes, and you can borrow 80, 100 grand a year for your kid to go to an Ivy League school with no job, with no income. It's crazy. It's the craziest thing ever. Now, that is the whole process of how you borrow the money from the school. You can always refinance to a private loan, but it's not about the interest rate. You might want to start with the federal loans and see what kind of an income-driven repayment plan you can get on. And then if you don't like the terms, or if you don't like whatever the payment is and you want to refinance, you can always refinance later. Okay, so in summary, my recommendation is don't pay cash for college. Don't use your cash flow. Don't use a 529 account. Definitely don't drain your retirement. I would borrow the money, roll the dice, see what the federal government does. Now, see if you could benefit from one of these huge discounts. You can always refinance to a private loan. You can always go from a federal loan to a private loan, but you can't go from a private loan to a federal loan. So I highly recommend at least starting with these federal loans. And then if you need to pay them off, you can pay them off, right? So, caution and disclaimer, you are dealing with the federal government, okay? These programs could change and probably have since the time I recorded this video. So you never know what the programs are, but these programs do exist and you should be familiar with them. You should consult with a certified student loan professional. Yes, that's a thing. It's a real certification. There are people that go through all of the licensing to be certified to help you choose the right income-driven repayment plan. But what you need to know for now is just take out the federal loans to send your kids to school. Then after graduation, you want to work with a certified student loan professional to figure out which income-driven payment plan makes the most sense for you. And then my biggest tip and my biggest disclaimer is plan for the worst and hope for the best, which ties in to secret number 3, the retirement scholarship strategy, which is how to get a full refund off the cost of college. So what I recommend is understanding how this is in combination with secret number 2, because how you pay for college is 10 times more important than how much you pay. All right, so I want to introduce kind of a new way of saving and paying for college. What if you could borrow money without required loan payments for less interest than you could earn on your savings to pay back these federal loans? So again, I recommend using these federal loans, but then while the kids are in school, let's start saving while the kids are in school at 6% plus, and then let's use that savings as collateral to borrow money at 5% and use those loans to pay back the federal government. Then your money continues to grow, your loans continue to grow, and this difference between that 1% difference between the two could give you a full refund off the cost of college, okay? So this is what I call the retirement scholarship strategy. How to send any student to any school of their choice and get all of your money back in retirement without scholarships or financial aid, even if you have a high school student or a college student, because you can use these college loans to pay for college. Then you can use this strategy to pay back the college loans, okay? This is the biggest savings of all because you get a full refund, and it works for any school, public schools, private schools, community colleges, trade schools, even if your kids want to get a certificate instead of a degree, or even if they're going overseas or starting their own business. It works for every scenario. Any student exceptionally gifted or gifted in other ways that does not rely on scholarships or financial aid. So for even high income families it works, and it works for younger students or students that are already in high school or college. And here's the key. It can be used for college. You can use this to pay for college, or like I just explained, you can use this to pay back these college loans. So this goes in conjunction with secret number 2. All right, so secret number 2 and secret number 3 work together. You only need 3 components for this to work: uninterrupted compounding interest, loans at a lower interest rate, and optional loan payments. And then again, you're going to be using your money. Your money is going to compound the rest of your life. You're going to borrow money without loan payments, which will also compound the rest of your life. And you're going to use those loans to pay back these federal loans, which even if they were at 8%, even if you had to pay them all back, and even if you couldn't refinance to private loans at a lower interest rate, you are still paying those loans back, which means the interest in the balance is going down. Now, let's put some numbers to it. If you started with a $100,000 Parent Plus loan and you didn't get an income-driven repayment plan at an 8% interest rate, which is high, but it is getting paid off. Every month that you make loan payments, the balance goes down. And if the balance goes down, then the interest goes down. So even at 8%, it's not a compounding 8%. So again, it will still work as a worst case scenario, even if you did have to pay back those loans. So again, if you want to learn more about all these secrets, if you want to learn how to maximize the scholarships and financial aid, if you want to learn more about the retirement scholarship strategy, or if you want to learn more about secret number 4, which are 3 strategies to triple your income in retirement to make up for helping your kids pay for college, all of this, you can learn more at collegefundingsecrets.com. Thanks for watching. I hope this was helpful. Again, go to collegefundingsecrets.com, learn more about some of these other strategies, reach out to us if you'd like to talk to us, and we'll help you work through some of these strategies one-on-one. Thanks again. We'll talk to you soon.